Good evening, everyone, and thank you for joining today's class. I know many of you guys are looking forward to how to build your wealth using real estate. So I think this particular topic sort of hits everybody's heart because everybody has to live somewhere, whether you're living in an apartment or you're living in a house or you're living with your parents, no matter what you're doing, there's a cost to that housing. And if you're paying for that housing, then you realize that the cost of housing is probably the most expensive part of your overall budget. Now, if you guys know, in the United States, a lot of motels are owned by the Gujarati community. See, they figured out a housing hack a long time ago. They said, look, if I can own a property that I can live in and rent at the same time, that's an awesome wealth building strategy. Now you might say, you know what? Yeah, I understand, Deepak, that's a great idea, but I'm not interested in buying a motel. So no, I'm not telling you to buy a motel, but I just want you guys to understand the strategy. So your housing is probably the biggest part of your budget. So if you're, let's say you make $10,000 a month, chances are you're paying $3,000-4,000 for housing. And then, if you take a look at your transportation budget, your insurance budget, your food budget, all of those are nowhere close to your housing budget. Housing is eating up most part of your budget. If you can take that money that you're paying for your mortgage or for your rent, let's say $3,000-4,000, and you can save that, whether in a pre-tax way or post-tax way, that can help you build wealth very, very fast. Wouldn't you agree? All right. So let's explore this concept a little bit. So what kind of homes we are talking about? Like I said, I'm not talking about motels and hotels. That's a different story. We're talking about traditional homes, your single family homes, your condos, your apartments, your mobile homes, even these days land, honestly. You might say, well, land is not a home. Yeah, it's not, but you can always put a tent on there. You can put a trailer on there. You can do other things with it. So even land is actually workable in some situations. Now, most people don't buy their house on cash. They have to get a loan, and loan is not cheap. There's cost associated with it. You got to pay mortgage. You got to pay, that includes your interest, that includes your principal. Then you got to pay property taxes. You got to get insurance on it. So all of that stuff that starts to add up. So I don't want to make this video about, whether you can afford a house or not. We're just going to assume that you can afford a house, but is there an alternative to that? Is there a better way to do that? Well, the better way to do that is if you can have somebody else pay for your mortgage. So you get to live in the house and somebody else pay for the mortgage. Okay. So how do you do that? Well, there are a few ideas I can share with you. One idea could be is you have a house, and that house maybe has 1 or 2 bedrooms, or maybe even a separate unit that has a separate entrance. Some of the newer homes are built as the next generation homes, and they typically have an in-law unit. So they have a little living space, it has a separate bedroom, and a separate entrance, or if you have an older home, maybe you can renovate it, and that way you have 1 or 2 bedrooms and a living space and small kitchenette that can have a separate entrance. In certain states like California, you can even renovate your garage. And if you can do that and you can rent that piece of the property out, that can produce rent to help you pay for your mortgage. Now, you see, what happens is normally this is done by buying multi-family homes. And oftentimes these multi-family homes are costly, and not just that they're costly, they also have a commercial loan. That means you have to pay higher interest, and on top of that you obviously got your taxes, you got your maintenance, and then you generate some income, but there is that problem with commercial loans. They're more expensive. So if you can live in a single family home and you can rent out some part of it to somebody else, okay, on a long-term basis, that means predictable. You can count on that revenue month after month after month. Then that can be a great alternative for building wealth. So how would you do that? So very simple. You get yourself a property that fits that parameter. Now, how do you find that property? Obviously, you need to explain this to your realtor beforehand that, hey, this is what I'm looking for. I'm looking for either next generation home or a particular home that's maybe had a bigger lot. Maybe it can have a separate entrance to the rooms, like something I can remodel by spending $20,000, $30,000, something reasonable, so that way you are cash flow positive. That's where you start. Okay. Now, what happens when you do that? Number one thing happen is, because it's your primary home, you're living in that home, you have a personal domicile in that state, you have filed a homestead exemption with the county that you live in. When you do that, you get two advantages. Number one advantage you get is your interest rate is lower compared to other loans. Like let's say if you want to go to commercial loan, that'll be more expensive. But if you stick with this, you will have a cheaper loan. And anytime you can reduce a cost, that's an advantage to you. Compared to whom? Compared to somebody else who is trying to do it professionally. So let's say if I want to go out there and buy an apartment building or 10-unit multifamily home, something like that, I would have to get a commercial loan, and that commercial loan is probably going to be 1%, 0.5% more expensive than your loan. So by doing this, by living in that home, you're already getting a cheaper mortgage. So that's a great benefit for you, right? That means your monthly payment's going to be cheaper. And if your monthly payments are cheaper, that means you can rent the home cheaper than I can. And if you can do that, you can attract more tenants. You can have, better occupancy. So that's all great. Okay. Now, what happens when you own a property? So when you own a residential property, that is your primary home, and you're also able to rent it out. So what you get to do is you get to proportionate how much of that unit you're using for your personal residence and how much of that you're using for business. And that gives you great advantage. What kind of advantage? Well, let's say if your house costed you $1 million and you're living in about 25% of that space, that means another $750,000 is available for your business activity, meaning you're renting that out. In that case, let's just say the land was about $50,000, so we'll take that out, and now we're left with $700,000 worth of equity that is being spent on investment property. That means you're renting that space out. I get to write off that's $750,000 as depreciation. You change a light bulb, that's an expense. You change a roof, you change your refrigerator, you change, you have to paint it. All of these things create something what we call paper losses. And those paper losses can be used to offset the income that you're generating out of your home. So let's say you generate $50,000 income and you can write off $50,000 in those paper losses. That $50,000 is completely tax-free, and you can use that money to pay your mortgage. So now basically tax savings and your rentals are actually paying for your property. And maybe you don't like that arrangement. Maybe you say, look, this is not really that great of a system for me. Maybe I don't want to live with the tenants and all that. Well, you don't have to do it forever. Maybe do it for about a year or so, maybe a year and a half. That way everything looks legit and you still qualify for that lower interest rate. And after that, you can move into a second home, a different home. I would recommend that you do it for at least 2 years. So that way, if you change your primary residence, you have some tax benefits there as well. But that's not really that important. I think there are better ways to deal with that as well. So that's what I would recommend if you can do that. Now, if you're really focusing on building wealth, then you can repeat the process again. Maybe you do that for a year or so, and then you buy yourself a second property. Now, here's the beauty about this. Every time you do this, it becomes easier to get the next property. You say, well, how's that? I'll tell you. Number one, you're building equity, right? That means you have more money in that home. If you wait for, if you buy a home this year, and let's say if it goes up by 5%, let's say same property, let's say you bought it for $1 million and it goes up by 5%, that's $50,000 of equity in that home that you have built up. That shows up on your financial statement. That looks like, that is part of your net worth. So it's good. It looks good on paper. It looks good to banks. It's very, very good. Number two, you go to a bank and you say, look, this home had 3 units or 4 units and I was only renting 3. Now I'm moving out. I'm buying the second property. That means I'm going to be able to rent that fourth unit as well. So technically, my income out of this house will increase. Guess what? That all becomes part of your financial statement. Your income is more now, right? And now once again, you're buying the second property and you do that same thing again. So this kind of makes it really, really easy for you to build wealth. So what happens? Well, first of all, you're generating extra cash. You have a great cash flow by doing this. Number two, you're able to claim a lot of paper losses. So that means you are not paying taxes on it. And three, somebody else is paying for your mortgage, or you're already, somebody is paying down your debt. And on the other hand, you're building equity. So your net worth is automatically increasing as well. So that's great. Another thing that this kind of investments allows you to do is leverage the borrowing. So what I mean by that, leverage the borrowing. So take a look. Let's just say interest rate changes all the time. Just a couple of months ago, I think interest rates were almost 7.5%, 8%. As I'm recording this with you guys, I think they're down to 6.5%. And there's a good chance they might go down to 5 or even 4.5 by the end of 2024. Or definitely by next year. At least that's how the trend is looking like. That means you can use that as to your advantage. So when interest rates are high, properties are usually cheaper. So if you already have a property that is cash flow positive and you're making good money out of it, then you can go to the bank and you say, look, I want to take some equity line of credit on it. I want to borrow some funds from it or whatnot. And you go buy yourself a second property. And when the interest rate comes down, then you refinance that property and use those funds at a lower interest rate. So it gives you a leverage, basically. That's something other people cannot do. It's just like another lever you can pull whenever you need to. So I think it's a great strategy to build wealth rather quickly. Another thing is that you want to keep in mind is if you are not maybe you are a W-2 employee and your spouse is not a W-2 employee, then another strategy you can use is that spouse should actually become a real estate professional. Now, they don't have to become a realtor. It will be helpful if they become a realtor, but the major requirement is that they spend at least 750 hours doing the actual real estate work. That means managing real estate, doing all kinds of real estate, and more than any other work. So if they're doing some part-time work here and there, helping you out, whatnot, that's okay. But majority of their time should be spent on managing real estate. The beauty of that is not just that you can take these paper losses against your rental income, you can also take those losses against your W-2 income. Now it's a wonderful strategy. Here's another strategy that I can give you. So let's say you are, late 50s, early 60s, and you're planning on retiring. Well, why not become a real estate professional? If you have done all the right things in the previous years, if you have built some portfolio of real estate, then in your retirement ages, become a real estate professional, because all that income that you might be generating from elsewhere, that can be written off against all the income that you are generating from your rental real estates. So great strategy, right? So what I tell my clients is that one of the easiest way to build wealth is to have this mindset that every year or every other year, we want to add another real estate to our portfolio. Don't rush into buying real estate just to save on taxes. That's a bad strategy because you will end up making a wrong decision. You really want to take your time and you want to find the right real estate. A real estate that you can depend on for a long time. Like, remember, your goal is to be able to rent it. If you cannot rent that real estate, our whole strategy kind of fails. So you need to find a real estate that you are pretty sure that you'll be able to rent it fairly easily. So focus on that. And then do a proper structure. So if you are doing it yourself with you and your spouse, I think you have a less risk. But nonetheless, you should at the bare minimum consider having an LLC. And if you have an LLC, then do it properly. So in our firm, the way we do it is we work with a law firm or a paralegal. And sometimes we don't use those if it's a very straightforward case where we see there's no risk involved. In that case, we set up an LLC. But otherwise, other than that, we kind of work with a paralegal and a law firm to set up a proper LLC. So what do I mean by proper LLC? That LLC is registered with the state. Your beneficiary information is filed with the FinCEN. You have the proper paperwork that includes your operating agreements, that includes your minutes, that includes your stock certificates, that include your seal, that includes your board of directors, your board of advisors, the whole shebang. That should be part of that LLC. And you should keep that in a good standing, because if you don't have it in good standing, that can create problems as well. Word of caution, if you do set up an LLC or you already have an LLC, be careful. You don't want to go out there and randomly start setting up an LLC in different states. LLC needs to be set up in the state where the property is located. So one of the most common questions people ask is, well, I live in California. I bought a property in Texas. There's no property tax. So, I'm good, right? I can build wealth very, very quickly. So the problem is, if you have a LLC set up in California and then you go set up that LLC here in Texas, then all of a sudden you have to register it as a foreign entity. And that creates a lot of extra cost and extra taxes, all bunch of compliance issues. You don't want to do that. Easiest thing to do is you come to Texas and you set up a property here. You buy the property here. Like, I give you another example. Let's say I live in Texas and I buy a property in state of California. What I should be doing is set up an LLC in California and pay the California state taxes, even though I won't pay any taxes here in Texas. Some states are less expensive than other states. For example, let's say California might charge 13% tax and some other state might be 2.5% or 3% tax. In that case, whatever taxes you pay in one state, you get that credited in another state. And if there's no tax, like for example in Texas, then whatever you pay in California, that's gone altogether. So you want to watch out for some of these things. And more importantly, make sure that LLC is owned by your living trust. And if that is not owned by your revocable living trust, then we run into a whole bunch of probate and other issues as well. So we want to make sure that is taken care of as well. Okay, so let's go back to the primary home example, because that's where we started from. So I'm going to try to tie all of this down, and then I'll open it up for your questions, because I think this is a wonderful strategy if you can execute it. So we talked about, just as a reminder, we talked about buying a home that is not just primary residence, but allows you to put another tenant, at least, maybe a duplex, maybe at least one more tenant, but maybe 2 tenants, maybe 4 tenants if possible. That's great. Okay. Number 2, it needs to be cash flow positive. You need to be able to make money out of it. If you're not making money out of it, then we need to do some math to make sure, is that even a right thing to do? Number 3, it needs to be in the right state and it needs to be in the right structure. If you make those mistakes, then that can also cost you. Number 4, that structure should be properly organized, not just with state, but all the paperwork should be in the order as well. So that way you are protected from that property as well. So those are some of the basics, but let's go back to our primary residence example. So one of the common questions people always ask, hey, Deepak, so should I go ahead and pay off my mortgage on my primary home? Well, just like anything else in finance and taxes, maybe, if you have a mortgage that is, let's say, 8%, 9%, 7%, 6.5%, and you cannot make that much money yourself by investing elsewhere, you don't know how to do that. You don't want to take the risk. You're just not comfortable dealing with that. Absolutely. Paid off. That you're making money. But there's a trade-off. The more you pay off, the more equity the house is, the more the risk increases. So how do you deal with the risk? So some of the ways to deal with the risk is, like I said, one is LLC. The other one is good insurance, good home insurance. And then top of good home insurance, you should also have good umbrella insurance. And then on top of that, you need to think about what else I can do to reduce my liability in that home. So keep those things in mind, that just paying off may or may not be the right decision. Just like anything else, I always recommend that when I make these videos or when I'm teaching a live class, I'm only giving a very generic answers. They are not pertain to your particular situation. Oftentimes, what we see generically might not be the right answer for you. I'll give you an example. I was working with a client recently, and he had just sold a home, and he was going to claim homeowner exemption on that home. And if it did that, that would have costed him almost $100,000 a year in taxes. Can you believe that? I mean, that would have been very, 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 very expensive mistake. So everything that you hear, they sound good, but before you act on it, just reach out to us or whoever you trust and run it by them and see if your thought process is correct. Are you missing something? Is there another piece of puzzle that might be missing out there? So please do that. So I hope this helped you answer some of those questions, and you at least have one more way to build wealth. Now, those of you guys who are new, because I'm going to put part of this video on YouTube as well for people who might be following us. So for you, if you guys want to join our live classes, like I said, we have a small business advisory group where we talk about how to grow your business. And then in addition to that, we have another small meetings, about 30 minutes to an hour. In these meetings, we talk about our market outlook, how is real estate doing, how is stock market doing, how is our economy doing, what can we do to get take advantage of some of these opportunities. So we kind of give you our point of view, our opinion as to how we see the world. And oftentimes people find them very, very helpful because we look at it from a different angle, different way that you might be not looking at. So if you want to join those, definitely go to taxcodeadvisors.com and you can join those meetings through there. They're happening almost every single week. So, and they're live, they're fresh, so they're not recorded sessions. It happens right in front of your face. So once again, thank you so much, guys. And I'm going to stop the video here and I'll start taking your questions at this point. Okay, John, you are up first, buddy. Go ahead.